Welcome back to Yahoo Finance Live. We're just a few minutes before the opening bell. And let's bring in Stuart Kaiser, UBS Head of Equity Derivatives Research, as we talk about the recent volatility we have had and see what is portended for volatility now. It was a rough September for a lot of folks, Stuart. So now that we're getting into October, now that we have the news of the Fed and its announcement about tapering, what happens now? Is there going to be a little bit more steadiness, or coming into earnings season, are we going to see more volatility?
Hey, good morning, Julie. Honestly, we are feeling, much more positive about things as we get through September. I think, coming into September, you had a lot of risks related to the economic data, related to uncertainty about what the Fed would do. And I think, very rationally speaking, a lot of institutional investors kind of hedged their portfolios, took down risk, and we're really sort of prepared for a negative month. Now that that's past us, as you mentioned, the event's kind of in the rearview mirror, and earnings ahead of us, we see pretty substantial upside to consensus estimates for 3Q earnings. So we think kind of the relief of being past those risk events, and then the positive news we expect to get over the next 2 to 4 weeks, should help markets get back towards their all-time highs again.
Stuart, wow. I started off the day pretty bearish on markets. I'm getting destroyed on Twitter, but what else is new here? That is an interesting take by you into earnings. Why are you so positive? We have seen a lot of companies come out here and warn. We've seen sell-side profit estimates come down over the past 3 weeks. Why are you so upbeat?
Yeah, look, I think, what you see in the last 2 or 3 quarters, frankly, is consensus estimates materially underestimate the earnings power of the S&P 500, for instance, and we think that's the case again. Our equity strategists see something like 7 to 10% upside to consensus estimates for 3Q. Hopefully the negative, pre-announcements have sort of gotten out of the way. And now that that's sort of baked into the cake, as we actually get reported earnings over the next few weeks, those things will skew positive and help push the markets higher. Obviously, there's some risk there. To your point, we could see more negative guide downs. We could see strong reported results with cautious outlooks and things of that nature. But by and large, we think a lot of the bad news has been announced, and we do think that those consensus numbers need to rise considerably. If you look at 3Q, the consensus estimate is for 7% lower earnings in 3Q than we had in 2Q. And that number we feel is just a really low bar, and the market will pretty comfortably beat that.
Interesting, Stuart. I just want to pause here because we're coming up on the opening bell in just a moment. Obviously, stocks under pressure, among other things. Evergrande was halted in Hong Kong trading and said that it was doing some kind of deal. It reportedly might be selling a stake in its property unit. So we'll see if anything happens with that. We saw some weakness in Asia on the back of that. And as we see the opening bell, there's a company called Wolfspeed, which is the renamed Cree, which is in the semiconductor industry, listing. We're going to hear from the company's executives later on Yahoo Finance Live, coming up in the 12 p.m. hour as those folks ring the opening bell this morning. And our opening bell coverage, our around the bell coverage, is brought to you by PIMCO. Coming back to Stuart here and what you were talking about, Stuart, in terms of earnings, I think you're sending Brian Sozzi reeling here this morning. We've been paying a lot of attention to profit margins and those warnings you were talking about. And it stood out to me in your note that you see good value in large cap tech stock call options. Is this a group that you actually think is going to be less vulnerable to, particularly the ones that don't make hardware? Are they going to be less vulnerable to some of the supply shocks that we've seen elsewhere?
Yeah, we do think that. And I think if you look back to the previous quarter, the stocks that moved the most on sort of input cost concerns tended to be consumer staples and areas of the consumer discretionary sectors that were really kind of coming under pressure because shipping costs and input costs had increased so much. We didn't see nearly as much pressure on large cap tech in that vein. So, we do see large cap tech as an area that is going to be a little bit less impacted by those input costs. Expectations have also come down a little bit for large cap tech. And we do think that, once they report earnings in 3Q, it's going to once again remind people about the earnings power and free cash flow generation of those companies. And I think the last 2 quarters, we've seen that pattern, which is those companies begin to rally a bit into earnings because people just get reminded about how strong fundamentally those companies are. So, we do see that as a potential, I don't want to call it safe haven, but we do see it as an area of good news in 3Q.
Stuart, let's say the jobs report this Friday misses estimates again. So that would be the second straight month. What do you think the market reaction would be?
Yeah, like I think it'd probably be a fairly negative market reaction, to be honest with you, Brian. I mean, obviously we were very surprised. We were above consensus last month and very, very much got surprised to the downside. And I think if you were to get another weak print, people would start to wonder about the cumulative effects of the COVID variants and things of that nature on economic growth. Would probably get people questioning whether the Fed is going to be able to taper on their schedule if we were to get another weak print on payroll. So it's a very, very important report. We actually think going into year end, payrolls rather than inflation is the most important economic data you're going to get on a monthly basis. So Friday is going to be a huge focus. If you look at how options are pricing it, they're pricing about twice the average move on payrolls relative to the last 10 years. So options market's also pricing a lot of uncertainty into Friday, which I think just drives home the fact of how important that data will be.
We will be watching it very closely. Interesting there. Payrolls more important than inflation for the markets. We watch both, but that is some good perspective here to give that weight to the payrolls. Stuart Kaiser, UBS Head of Equity Derivatives Research. Thank you so much. Good to see you.